Welcome to EXOUSIA Investing TV, your premier destination for unlocking the keys to financial empowerment and mastering the art of money management. Ever wondered what a mortgage is and how it works? Well, let's break it down. Picture a mortgage as a type of loan, a very special one, specifically designed to help you purchase or maintain a home or property. Yes, that dream house you've been eyeing can be yours with the help of a mortgage. Now you might be thinking, but what's the catch? Well, like any other loan, you, as the borrower or homeowner, are required to pay back the loan to the lender. However, this isn't a one-time payment. The repayment happens over a set period, typically ranging from 10 to 30 years. This period is what we call the term of the mortgage. So, in essence, a mortgage is a long-term loan that helps you own your dream home now, while you pay for it over a number of years. Now that we've defined what a mortgage is, it's time to delve into how it works. So, how does a mortgage work exactly? Let's dive into the nuts and bolts of a mortgage. At its core, a mortgage has four key components: the principal, interest, term, and payments. First up is the principal. This is the actual amount of money you borrow to buy your dream home. If you're purchasing a house for $200,000 and you put down 20% or $40,000, your principal would be the remaining $160,000. This is the sum that your lender provides and which you agree to pay back. Next, we have the interest. This is the cost of borrowing money, and it's how lenders make their profit. The interest rate is a percentage of your outstanding principal. If your interest rate is 5%, then every year, you'll owe 5% of whatever part of the principal you still haven't paid back. Now, let's talk about the term. The term of a mortgage is the length of time you're given to pay back the loan in full. Terms can vary widely, but the most common ones in the United States are 15 and 30 years. The longer the term, the more interest you'll end up paying over the life of the loan, but your monthly payments will be lower. Lastly, we have payments. These are usually made monthly and consist of both principal and interest. At the beginning of your mortgage, most of your payment goes towards interest. But as you decrease the principal over time, more of your payment goes towards paying down the principal. Understanding how these components interact is like finding the key to a puzzle. It's the principal that you're steadily chipping away at, the interest that's always tagging along, the term that's ticking down, and the monthly payments that keep everything moving. Understanding these components is crucial to grasp the overall concept of a mortgage. Now that you know the mechanics, you're well on your way to becoming a mortgage pro. Did you know there are different types of mortgages? That's right, not all mortgages are created equal. Today, let's delve into the two most common types: fixed rate and adjustable rate mortgages. So, what is a fixed rate mortgage? As the name suggests, it's a mortgage where the interest rate remains the same throughout the entire term of the loan. Whether it's a 10, 15, 20, or 30-year loan, the interest rate you start with is the one you'll end with. This type of mortgage is like a steady ship sailing through the choppy waters of fluctuating market interest rates. It offers predictability, allowing you to budget your finances with certainty. If you love stability and predictability, this might be your go-to choice. Then, we have the adjustable rate mortgage, also known as an ARM. Unlike its fixed rate cousin, an ARM has an interest rate that can change periodically. This type of mortgage is like a roller coaster ride, with interest rates that can go up or down based on market conditions. The initial interest rate is usually lower than that of a fixed rate mortgage, making it attractive to some. However, the rate can adjust over time, potentially increasing your monthly payments. To give a bit more detail, an ARM typically begins with a fixed interest rate for a set period, say 5 years. After this period, the rate will adjust annually. These adjustments are based on changes in a reference interest rate like the US prime rate or the London Interbank Offered Rate. If you're a risk taker or planning to stay in your home for a short period, an ARM might be worth considering. As you can see, both types of mortgages have their own set of advantages and potential drawbacks. It all boils down to your personal preferences, financial situation, and long-term plans. It's always crucial to understand all the details before making a decision. After all, a mortgage is a long-term commitment, and choosing the right type of mortgage can make a significant impact on your financial future. Why is understanding mortgage important when buying a home? Well, here's the thing. Buying a home isn't just about the sticker price you see on the listing. It's about understanding the long-term financial commitment you're making. And that's where a mortgage comes in. A mortgage isn't just a loan, it's a tool that allows you to spread the cost of your home over a set period of time, usually over several decades. Understanding the ins and outs of your mortgage can have a significant impact on your overall budget, both now and in the future. This knowledge can help you determine how much home you can realistically afford, and how it will affect your monthly budget. It also plays a crucial role in your long-term financial planning. The terms of your mortgage can affect the total cost of your home, your equity buildup, and even your retirement plans. A good understanding of mortgages can help you make informed decisions when buying a home. Let's summarize what we've learned about mortgages. A mortgage, in simplest terms, is a loan that helps you buy a home. It's a long-term commitment, usually spanning 2 to 3 decades, where you'll make monthly payments to gradually repay the borrowed amount, plus interest. We've also delved into the mechanics of a mortgage, understanding its main components: principal, interest, taxes, and insurance. These elements combine to form your monthly payment, a critical figure to consider when planning your home purchase. We've explored various types of mortgages too, each with its own merits and drawbacks. From fixed rate to adjustable rate and government-insured to conventional loans, there's a mortgage type to suit different financial situations and home buying goals. The knowledge of these concepts can immensely aid potential homebuyers in making informed decisions. And with that, we've demystified the concept of a mortgage. Remember, knowledge is power when it comes to home buying.